Sheila Vertino, and I'll be your host for today's briefing. Just to tell you a little bit about the Solution Series program, as many of you know, our goal is to provide you in a very short time slot with some fresh insights and practical tactics, positive strategies, that type of thing, to help you succeed in today's tough business environment. As always, we encourage you to drive the content. Let us know what types of presenters, what topics you'd like to hear about in the future. You can send us an email, or you can also fill it in on the evaluation form that you'll receive at the end of today's program. I'd like to especially thank the Harvard Business School Real Estate Executive Education Programs for sponsoring today's program. These executive programs are designed to help seasoned and emerging leaders protect their assets and manage complex projects. In addition, participants will gain the skills they need to navigate global markets and capitalize on new opportunities. If you'd like more information, go to their website at exed.hbs.edu. Larry, if you could advance the slide for me. As I mentioned, the Solution Series is great for quick bursts of information, but some topics require a more in-depth discussion, and for that we have 90-minute webinars. There we go. As you can see on the screen, the next full webinar is taking place on Thursday, April 8th, and the topic is capitalizing on demographics and expanding your development horizon. The theme here is talking about pursuing growing opportunities by expanding your business platform into things like senior housing, student housing, medical office development. The cost of the webinars is $65 for NAIOP members, $95 for non-members. If you'd like to register for this webinar, you can see, you just go to naiop.org/webinars. And now to the next slide, please. We are ready to get on with our Solution Series program today. Our speaker is Larry Lance, and Larry is Principal and Chief Operating Officer with Alliance Commercial Partners. Larry directs the overall corporate operations and the asset management function of the Alliance portfolio. He's directly responsible for operating budgets, leasing, and property-level strategic plans. Larry is a strong friend of NAIOP. He's on the board of directors for NAIOP Colorado and has served as National Chairman and Vice Chairman of the Office Development One Forum. In addition, Larry serves on the NAIOP Corporate Board of Directors, the Tax and Finance Corporate Subcommittee, and he's a NAIOP PAC trustee. You know the old adage, if you want something done, ask a busy person. So that's why we reached out to Larry. Welcome, Larry, and thanks for being with us today.
Okay, thank you, Sheila, for the introduction, and thanks to all the listeners on today's Solution Series. I've been asked to share some of my views and experiences on successful portfolio management strategies over the next 20 minutes. Not a topic that can really be fully explored given that amount of time, so I'll try to keep my comments as brief as possible, but hit some salient points. Before I go through the agenda here, let me give you a little bit of a quick description of who Alliance is. We were founded in 1996. We've invested approximately $1.8 billion in commercial transactions, 134 transactions since then, totaling over 18 million square feet. We're headquartered here in Denver, Colorado, sunny Denver. We've raised or invested through a series of private equity funds, 8 of them to be exact, and so that gives you a little background from where I'm coming from as I go through my slides. Now for the agenda. What I'm going to try to cover here in this brief time that we're on the phone together is the following kind of 4 major points. What we see today, the strategy and execution component of portfolio management, the hold sell question that we all need to make, and then the timing of the real estate markets. I thought I would start by kind of going through a slide that gives us all a little bit of a perspective, but kind of what we see in the market today clearly is an important data point in executing on asset strategies. Understanding today's market helps us to project future results in the portfolio. This slide, it just gives us a real quick summary of the current market, the perspective that we're looking at today, and how property this is an Case-Shiller index as well as an MIT commercial property index. You can see how property values in residential was about 2 years ahead of on the peak than commercial properties, and you can see the radical decline and actually the radical increase in values of nearly 60% over a 4-year period. Kind of crazy numbers, and then the correction that we find ourselves in today. We're clearly in a very, very difficult environment today. For commercial real estate, in most markets, values are off 30 to 40% from peak pricing, as you can see in that last slide. In most of the markets we're seeing, it really presents an interesting portfolio management challenge when you, as in our portfolio, we're on sort of acquisitions, we're like 60% levered, and so if you've got a 30 to 40% pricing influence on recent vintage acquisitions, it does represent a really significant challenge. Deteriorating fundamentals. Vacancies, our view anyway, is vacancies will continue to increase and rents will probably keep decreasing across most property sectors. I see that probably happening throughout most of this year. The debt markets are improving ever so slightly. There seems to be a more of an attitude to issue debt, and spreads have actually narrowed slightly over the last 60 or 90 days, and loan-to-value proceeds are going up somewhat. So that's good news. Another good news in terms of today's market is that there's really no new development to speak of, a very, very small percentage of the supply. So the supply is pretty fixed, relatively fixed anyway, in most markets. So this is really a demand recession, not a supply recession like we saw in the early 90s or even early 2000s. I mean, there's really not, going into this recession, there really wasn't a whole lot of oversupply in the development side. Asset pricing has increased over the last 60 days from our point of view. We're seeing cap rates come down a little bit, 25 to 50 basis points, but most markets are still 200 to 300 basis points above peak pricing. We're all aware of the massive amounts of foreclosures and workouts that are going on in our industry today. We've clearly seen more transactions that are getting done. There's going to be, and we're seeing it happen as we speak, a massive amount of sort of resetting of bases, and you're going to continue to see that throughout the year. For whatever it's worth, our experience at least represents one data point in the industry. This past year in 2009, we restructured 10 loans, and we would expect to manage through another 13 loans this year in 2010, and either restructure or extend, and and all that comes it comes with an element of portfolio strategy in terms of capital. As a result, though, we definitely see the deal flow expanding in 2010. We think that the lenders and owners are going to narrow the bid-ask spread, and more lenders are probably going to be selling assets. Relative to deal flow in 2010 and 11, I guess it would really be hard to see less deal flow than what happened in 2009. So our next slide is strategy and execution in portfolio management. We all know that real estate has evolved into more of an institutionally acceptable investment class. Investors have generally allocated, some small percentage of their assets in the quote-unquote alternative investment category, where real estate resides inside the investment portfolio. This has actually created a market for fund structures. Over the last couple of decades, a lot of funds have been raised in every asset class. There's really two main types of funds or portfolios, and the first one would be the closed-end fund, which is what Alliance does primarily. where there's a limited amount of capital that can be drawn down, commitment of capital, and that's what we've done. And then the open-end fund strategy is one that really provides for some liquidity for investors using sort of periodic valuations. The open-end funds, generally the principals would have limited or no control over the strategies that are employed, and real minimal control over decisions. So what's developed out of these fund structures, though, is a principal and agent relationship base. As an operating company like Alliance, we have relationships with brokers, managers, investors, partners. The insurance company industry uses correspondents. Conduit providers use, mortgage originators and servicers. And if these relationships are to work successfully, it's really important for us to develop, a clear statement of the proposed investment strategy, and to really have a means of regular assessments, and whether or not we're adhering to the agreed upon strategy, with the investors, or I might say, given today's environment that we're in, or a modified strategy. In portfolio management today, while you may have a very defined strategy going into the investment period, with what's happened in the industry and in the marketplace is that, I think the best portfolio managers and asset managers are able to, use their experience and education and adapt to new modified strategies. So, as if, do we revise the business plan? Do we, in our portfolio, we've sort of grouped properties into, sort of category A and category B, and we're asking ourselves, which ones do we want to defend? How would defending this asset allow us to maximize the yields on our overall portfolio? And or maybe said another way, in today's environment, is how does defending certain assets in the portfolio allow us to return the most amount of capital? And a lot of fund managers in the industry today, I think most of you would realize and understand that there's, particularly in the latest vintage of investment, there's funds out there that have suggested to their investors that they'll get zero capital back, or a very small percentage of the capital, let alone a yield. So I think we find ourselves in an environment where a good portfolio manager really needs to, really needs to communicate very effectively with their investors. Asset reports, both financial and business plans, need to be presented timely and accurately. We recently started a service company to provide property-level accounting on our investments that rolls right up into the asset level and portfolio level reporting. We're using the MRI platform, and it's our belief that we'll be able to provide more timely and efficient reporting and forecasting of cash flows. I think it's important to appropriately reward those who perform ahead of expectations. Again, we're in an environment where expectations going into these portfolio funds were, probably, at least in our value add strategy, yields in the high teens, low 20% yields. Now there are no rewards relative to that structure. So the question to be asked is, do you rework the incentive compensation plan for the manager? Even after the manager says, listen, I'm not sure I can make a yield, I'm not sure I'm going to get 100% of the dollars back. This is more of a question than a strategy that we're employing right now, but do you rework the rewards or the incentive expectations for somebody who may say, listen, I can get, I think, 80 cents on the dollar back of the invested dollars, and whereas another fund manager may say, I think I can only get 40 cents back. For that extra 40 cents of sort of equity return, is it worth reviewing or talking about some sort of a performance reward? In most instances, probably not, but I think it's something in today's world you got to ask. Not every relationship is successful. I think you got to fire underperforming managers and agents, and I don't think you fire them next month or 3 months from now. I think you do it now. Just hard decisions have to be made in difficult times. I think it's a clear and productive and timely process for joint decision making. I mean, the portfolio managers need to develop very good processes and communications with their partners. It's so important. We spend just an inordinate amount of time talking with partners and JV partners and investors, and to make sure that as we modify these investment strategies, that everybody's on the same page. Everybody signs off on what the new strategy should be to try to perform on, and then we got to go out and execute. So, performance measuring systems. We have business plans for each asset. We ultimately get measured and graded, probably informally all the time with our investors. When you reset a plan or a strategy, you should also reset your efforts and how your efforts might be evaluated. Per my earlier example of if we can get a large percentage of the equity back in a given fund, is that considered terrific results, okay results, terrible results? I think that resetting the bar and and being able to really go out and execute on a new strategy or a modified strategy is important in today's world. The next section is really the hold and sell question, and I think this decision to sell is really a mirror image of the decision to buy. Both decisions are best made within a context. What do I want my portfolio to accomplish? Will a sale move me closer with greater certainty to a favorable result, or will it move me away? What is the strategy of the portfolio? And again, the strategy in the later vintage portfolios that were invested in, let's say that 2004 to 2007 time frame. My sense is it's probably not the same strategy as what it was when the investors went in, and we can do a great deal of good by modifying the strategy, trying to get an agreement on it, and then pursuing a new strategy that ultimately protects as much equity or provides as much yield as possible in today's marketplace. The fundamentals are clearly important, as we went through earlier, to kind of today's view of what we see today, the local markets and the capital markets. I mean, you got to understand where we're at in the marketplace to understand whether or not it should be a buy or hold question on a given asset within the portfolio. The goals for the investment program. Let's assume that includes all of our existing funds. We need to ask ourselves and the investors some very simple and useful statements of goals. And again, we spend an inordinate amount of time communicating with our investors. I think that's the right thing to do in today's world. Everybody's nervous about the capital that they have deployed in all different asset classes, real estate, of course, being one of them. And I think as you reestablish new goals for the investment program, it's really important to communicate, with all your investors. And I find that that feedback from our investors is terrific when we communicate as actively as what we try to do. The market, as well as asset management, clearly contribute to the asset's performance. Our strategy, as I indicated, has been primarily value add. It's striving for an overall portfolio yield, and if we execute on the strategy, once we've repositioned the asset, does the market allow us to exit? And that's what we're groping with right now. And if the market does allow us to exit, then most of these funds and portfolios are graded out on an overall yield or an IRR perspective. So it's generally once you've stabilized and repositioned the asset, it's almost always the right time to sell, but for the market. And you kind of see three different markets: a stable market with maybe healthy fundamentals. If you've executed on your asset plan, you would obviously sell into a stable market with healthy fundamentals. In a rising market, you would clearly sell as well. In a falling market, the one like we've had the last 2 years, you've got to kind of ask yourself, do I sell now, and would that generate better yields or better recovery of equity for the portfolio, or do I wait, and in some cases wait, and you could look at one of the earlier charts that would suggest if you waited for a year, you would actually sell it for less money. So these are very tough decisions to make, and I think it's important that everybody just strategizes together and to make sure that they're understanding what all the options are. This slide is kind of interesting. It just looks at how the cap rates have, and the spread between cap rates and Treasury bill yields have narrowed in this very high value frenzy time that we're in 2005, 6, and 7. You can see that the cap rates were within 100 basis points of the most safest instrument in the world, U.S. Treasuries. And I got to tell you, real estate is not a game that should be priced 100 points. The yield should be priced 100 points above U.S. Treasuries. That has grown. Now that would have been a good time to sell, however, as you see in sort of a portfolio strategy. It would have been great. I mean, a lot of us that run portfolios would, in hindsight, would love to have tried to execute, even if the buildings weren't fully leased and you haven't fully completed your business plans. A genius might have discovered that would have been the right time to try to sell assets regardless and gotten paid for it. Today we're at, probably 400 basis point spread to Treasuries, and while this chart says that the historical average is more like 200 basis points, I would actually kind of argue with, that a 300 or 400 basis point spread is probably kind of the normal risk spread against U.S. Treasuries, and we're probably a little bit wider than that right now, and I see that probably narrowing just a little bit. So the last topic is really the timing, the timing of the real estate market, and buying and selling timely can make just a substantial difference in the long-term returns of the fund, particularly in a value-add strategy. In our newest fund that we've just raised, we're trying to be active buyers. Playing in this upcycle profitably will clearly depend on buying assets right and on operations, effective management and leasing. So a perfect market timing strategy is based on good data and forecast. I mean, we're constantly looking at real estate industry research reports, capital market research reports, broker market reports. That we use these extensively, and as we try to evolve and try to market or model the market trends and how they can play into overall yields, and then we just got to go out and execute. So probably the hardest part is, there's not a lot any of us can do about the marketplaces, but we can execute on strategies. And if the strategy is not working, I think what we're all being asked to do is, come up with another idea. How are we gonna protect this asset? How are we gonna protect this, this fund and the amount of dollars that are invested in it? And then ultimately, local market knowledge. It's important to have. I mean, it's just essential to have really, really good local market knowledge. We rely on really deep-rooted, relationship-based knowledge in the markets and where we invest, and spending the time and the energy and the effort to play and be in those markets, be active, participate in activities, just know just try to know who's doing what. And there's no replacement for just very, very solid local market knowledge. So in closing, what we're trying to do as a behavior in our company is just, we really try to stress with our people, let's practice. It's a very difficult, environment that we're all working in today. There's a lot of stress on a lot of people, but let's just maintain our core values. We talk about it all the time, but integrity. Risk and rewards are shared by all. We own mistakes, but but we need to manage the risk as best as we can. And then, we have a view that, who is more important than how much, and a handshake is better than any contract. And then we just try to very, very clearly communicate all our goals and objectives. So that is my quick summary. And I think there is time for questions if there were any. But I appreciate everybody's time and listening in today. And I hope that this has been a little bit helpful anyway. Thank you.
Thanks, Larry. That was a really good overview, or a reminder of the importance of fundamentals, and also some additional clarity about how you might need to change some of your strategies, given the local market. But there's still opportunities to succeed. So thanks again for sharing those rules of thumb with us. For anyone who would like to hear this presentation again, we'll be posting it online at the NAIOP corporate website. It'll be up by the close of business today. So if you want to go find it, go to NAIOP.org. And on that front page, there's a large button that says Solutions Series. If you click on that, you'll see this program and actually archives of all the past programs. These are available at no cost to NAIOP members. The next solution series is on April 14th, and we are going to tell you that we have Stan Ross, who's coming for that program, and he is the chair of the USC Lusk Center for Real Estate. He's going to talk about how to take the right steps to stay in business and emerge stronger from this downturn than when it began. So, again, good advice for many. Watch your email for a message from NAIOP Corporate. I'll give you more details about the registration on that. Remember, if you have topics that you'd like us to cover, just send us an email or put them in the comments section on the session of evaluation survey that you'll receive right after this program. Thank you again, Larry, for your presentation today, and thank you all for attending. Goodbye for now.
Okay, thank you.